about Austrian economics, I had the chance to speak with Lawrence White, author and professor of economics at George Mason University. Now, I first asked him why we see so many booms and busts today. Here's what he had to say.
Well, there isn't one theory that covers them all, but an important set of booms and busts is due to monetary policy, due to cheap credit that lets an investment cycle get out of hand. Often it's because there's some genuine investment opportunities. Investors come to the banking system, they start bidding up the interest rate, and the central bank decides, no, our job is to keep interest rates low. And that lets investment go too far. You get too much investment, and you get investment in things that are interest sensitive, especially if the central bank's keeping the interest rate below the rate that would clear the market for, maintain savings investment equilibrium.
So would you say that the credit boom was responsible for this last bust that we're actually still kind of digging our way out of right now?
Absolutely. I mean, this is one of the clearest cases. This is why Hayek's theory got brought back to the forefront and why Russ Roberts and John Popola made that video, because it's such a clear case of a credit boom that went bust. With
interest rates at 0%, and they've been that way for a while now, would you say that low rates favor more capital-intensive output and investments with long payback time work?
Yeah, so if you're an investor and you're looking at a long-term project, you got to convert the paybacks, say 10 years in the future, to what they're worth today, and that depends on the interest cost of carrying the project forward. And so the lower the rate you can borrow at, the more profitable that project is going to be. So projects that wouldn't be profitable if you had to finance them at 5% become profitable if you can finance them at 3%. And that's especially true the longer lived they are, because then there's more interest in the total cost of financing.
You know, when you think about projects, infrastructure projects, those are very expensive. Yeah. We're not seeing as much infrastructure given these zero rates, given that theory. Do you know why?
Well, infrastructure is a mix of public and private, and I can't tell you what the motivations of the public sector are. They're not always economic. But right now is not a good investment climate. There's a lot of uncertainty, and I think that's discouraging investment in plant and equipment that we would otherwise see at these near zero rates.
Right, and then when we talk about this payback time frame that are longer, that's probably why you're seeing more investments in real estate now, in projects that do come from the private sector where you can borrow money cheap at this point, would you say?
It's certainly why we saw so much investment in real estate
in the first go-around.
In the last decade. Real estate's kind of mixed right now. People have been burned once. They don't want to be burned again. But yeah, the Fed is going out of its way to make real estate investment cheap. You know, they're holding more than $1 trillion of mortgage-backed securities to keep their prices up, keep yields down, make it cheap to borrow for real estate.
Which you're not a fan of, obviously.
No, that's a distortion. I mean, that's diverting funds that could be more profitably used somewhere else.
Yes. Now, Bloomberg, they ran a story today. The headline was, Fed scrutiny of leveraged loans has grown along with bubbles concerns. So is that the kind of thing that you've been talking about?
Yeah, so high leverage is that is a high ratio of debt to equity financing. That's a symptom of debt financing being relatively cheap. And so people will pile into it because it's the cheapest way to finance the project. Now,
but could you also say they pile into it because they're the highest returns as well?
Yeah, the highest returns after you take out the cost of financing the project.
Obviously,
so I think we're saying the same thing. There's been more leveraging. In fact, since the crisis, I just read this the other day, private sector debt in the G20 countries is actually 30% higher than it was just before the crisis. So we haven't deleveraged the way we should have. The incentives are all in the other direction.
Now, Dr. White, right now debt to GDP is soaring, and the latest Geneva report on the economy shows that, I want to get this right, global debt to GDP is at 221% today, and that's up from 180% just 6 years ago. So it's kind of what you were just, there you go, there's your 30%. So would you say that another unsustainable credit boom is upon us?
I'm afraid so. It's a little harder to point to exactly where the asset price bubbles are.
But it has formed globally.
That becomes clear later on, but yes, there's a lot of investors searching for yield and investing in things that aren't going to pan out because in a low interest rate environment, that's where the incentives lie.
Now, I want to talk about this whole boom and bust idea in this cycle. You know, there's human psychology as well that comes into this. And, I mean, would we get caught up in these manias, kind of, you know, these crashes, even if there wasn't, you know, even if the market set interest rates, it wasn't set by the Fed? Isn't that just human nature?
It's human nature for some people to be overly optimistic, but when you see it systemically, when you see a wide array of people, then you have to think that there's something distorting their incentives. And of course, central bankers get caught up in these things too, so they're not really the ones to put a stop to it.
So here's the question, what's the solution then?
Well, there's a built-in market mechanism that sort of constrains asset bubbles, investment booms, and that is, as everybody wants to invest in the latest thing, if the supply of funds for borrowing hasn't been expanded by the central bank, the interest rate starts to go up, and that puts a brake on things. Right? That cuts off some of the projects which are at the margin of the investment, and only the ones that promise the best returns, risk-adjusted, will get financing. But if everybody gets financed, then you get a lot of investments that are going to go bad.
Now, before we were speaking about this, you know, credit boom kind of beginning to form globally. Yeah. But what causes these booms to take on this international flavor? Is there any thinking in the Austrian School of Economics that deals with this specific question?
Well, I'm not sure what Mises or Hayek had to say about it. I mean, what I would say is we see a lot of herding behavior among central bankers. So the U.S. has ultra-low interest rates. European Central Bank has to have ultra-low interest rates. Japan has to have ultra-low interest rates. That's the way they think about things. So they're trying to match each other in stimulating, that's how they think it works, their own economies.
That was Lawrence White, author and professor of economics at George Mason University.